Good morning and welcome to our Marsh webcast focusing on the total cost of risk. For those who have just joined us, I am Gert Wal, the Clients and Markets Officer for Marsh Advisory. I will be your MC for the entire session today. Before we start, I will ask you one question to check if you can see and hear us well. Just indicate in the chat function by typing yes or no if you can hear me well. Anyone can do this. Very good, very good. Thank you very much. I see everyone is hearing us well. Please, can I have the next slide? Today, we've got a great panel for you. I'm joined by Kubani Tuniswiswa, our risk management leader for Marsh Africa. If we can go to the next slide and show pictures, please. Thank you. Also, Mornay Lawrence, our sales leader for Marsh Advisory, and Claver Mambura, our practice leader in risk analytics in Marsh Advisory. If we can go to the next slide, please. If I can just explain to you how you can talk to us during the webinar. If you have any questions during the presentation, then just click on the Q&A icon in the lower left-hand corner of your screen. Using the Q&A icon helps us record your questions should we not be able to get to them during the session, and then we can revert back to you later. Then type a question in the open area and just click submit. We will also have a Q&A session during and at the end of the webinar to answer your questions. If we don't get to your question today, we will make sure that someone from Marsh gets back to you as soon as possible. We will also be running a few live polls in the session today to keep the session as interactive as possible. And to that effect, you're also welcome to use the chat function like you just did. We will hear from our panel in a moment, but first a quick overview of what you can expect from this webcast and a quick video to give you an overview of who Marsh is. That video gave you a broader perspective of who Marsh is. You can also visit us at www.mmc.com. Without further ado, I am now handing over to our first presenter, Kubani Tuniswiswa, our risk management leader for Marsh Africa, who will be taking us through how to build business resilience. Kubani, over to you.
Thank you, Gert. Good morning, everyone. My name is Kubani Tuniswiswa. I'm the risk management practice leader for Marsh Africa. I'm joined by our business partners, Marsh Advisory colleagues. Welcome to the Total Cost of Risk webinar. My topic of discussion this morning is about building business resilience under evolving risk landscape. The discussion is anchored on holistic approach to risk and insurance. I want to make a statement from the beginning and say that Marsh, as the strategic business partner, is well positioned to assist clients achieve the optimal total cost of risk. Next slide, please. Marsh has developed 6 core capabilities that inform the work that we do in the service of our clients. One of our core capability is called Trusted Risk and Insurance Advisor. We believe that as strategic partners to clients, Marsh is able to assist clients build sustainable and resilient businesses. This we do by developing innovative risk and insurance solutions at strategic and operational level. What tends to happen most of the time is that we give advice mainly on transference of risk to open insurance market. This is what transactional brokers do. We are now positioning ourselves to engage clients more at strategic and operational levels. Marsh, we believe, once again, that is an enabler in building business resilience and reducing the total cost of risk. Next slide, please. There has been a seismic shift in approach to risk and insurance. Clients are adopting a holistic approach to risk and insurance at a more senior level than before. This is driven in recent times by COVID-19. Marsh welcomes this shift in approach and thinking. We are ready to contribute and add value to client engagement. The board of directors of many companies are taking keen interest in risk exposures faced by their respective corporations. The risk exposures are now front and center of most board meetings. The global emerging risks are being discussed seriously at board meetings in an effort to protect the business and at the same time build a resilient business that can withstand hardships. The global risks that get airtime at board meetings include, amongst others, non-damage business interruption risk exposures that have got a huge impact on profits. Secondly, directors and officers' liabilities, cyber liabilities, especially now during COVID-19 with employees working remotely. The boards are also seized with credit and political risks. Risk mitigation strategies, and boards are also interested in the total cost of risk, which is the subject of today. As the strategic partner, we want to engage clients on these key and top of mind issues. Next slide, please. Here, I want to refer to the World Economic Forum Risk Report. The report is produced by the World Economic Forum in partnership with Marsh and Zurich Insurance Group. This report deals with global risk exposures and demonstrates how these risks are interconnected. The World Economic Forum Risk Report assists companies with planning, with people and asset protection, with liability management programs, including environmental liability, as well as putting in place a robust business continuity plan. Next slide, please. Governance, risk, and compliance framework is about accountability. It is about providing risk and insurance solutions to company risk exposures, starting at the very top with the fiduciary duties of directors and cascading down to various lines of defense, be it executive committees, risk management and audit committees, internal and external assurance providers. As Marsh, we can play our role as trusted risk and insurance advisor by providing various solutions like enterprise-wide risk management, various risk mitigation and insurance strategies, business continuity management plans, property risk consulting, amongst others. All of this talks to the total cost of risk, as well as developing strategies to achieve optimal total cost of risk. Next slide, please. This graphic details our approach to risk management. This approach provides the framework for how we assess and mitigate risk exposures. Firstly, we determine the exposures by primarily identifying these risks. Then we quantify these risks in terms of likelihood and severity. Once these exposures are determined and quantified, we are then in a position to determine the correct treatment of these risk exposures. We can provide the following solutions to clients. One, mitigate risks by implementing various risk management practices, putting in place, for example, business continuity plans. We can provide solution by transferring risk to the insurance market by negotiating the most cost-effective insurance program. Thirdly, retaining risks on balance sheet and clients take losses as they come. Marsh can also assist with risk-bearing capacity exercise to determine the risk retention appetite. And fourthly, funding the risk exposures by putting in place risk financing strategies like contingency policies, cell captives, etc. Through this, we deliver results and we are judged by, firstly, lowering of costs, optimizing capital. Capital is scarce and it is expensive. And divisions within corporations, they fight and compete for the allocation of capital. Hence, it must be managed very well. Thirdly, improving business safety and enhancing business resilience. And finally, maximizing recoveries. In conclusion, this level of client engagements that we intend rolling out to our clients using our guiding client business framework that we call belief-based engagement, which deals basically with business needs analysis. This is all about clients first and foremost, and how Marsh can bring tailor-made risk and insurance solutions to clients. Thank you for listening to me, and I will now hand over back to Gert-Val.
Thank you, Kubani. And you've received a question. The question is, how does a holistic approach to risk support business resilience in an evolving risk landscape? Could you please answer that for us, Kubani?
Yes, thank you for that, Gert. I mean, as I've said in the beginning, holistic approach to risk talks to the interconnected of risk. If businesses adopt this approach, they are in a position then to be able to develop strategies that help the business thrive and withstand hardships. Business resilience is the way forward for businesses. Holistic approach helps with business planning, business continuity, protection of people and assets, assist with the development of liability management program, assist with the development of risk management strategies, also assist with lowering of costs as will be discussed under the total cost of risk section of our webinar. The benefits are substantial. Viewing risks in isolation is not productive and it is expensive.
Thanks for that, Kawani. And then again to our audience, please remember to submit your questions throughout this session by clicking on that Q&A icon in the lower left-hand corner of your screen. Then just go ahead and type your question and submit. Okay, next slide, please. Our next section then will be co-led by Mornay Lawrence, our sales leader, and Claver Mamvura, our practice leader in risk analytics, who will be taking us through the total cost of risk.
Thank you, Gert. Good morning, and thank you all for joining this session on refining total cost of risk. As mentioned, my name is Mornay, and I work for Marsh Advisory, and I'm joined by Claver, the practice leader in our analytics department. Next slide, please. So I seem to have a flyer like Mike Pence on his session, so sorry about that. In this session, we'll be focusing on the components of total cost of risk and what you can do to reduce it. Next slide, please. So let's kick off and understand total cost of risk and the components of total cost of risk and how you as a business need to navigate daily through those different risks. Broadly speaking, there are two categories of risk: business risk and insurance risk. Business risk reduces your profitability and even in extreme cases may lead to bankruptcy. You may never be able to avoid these risks, but through strategic risk planning, you may mitigate its impact. Insurance risk is that risk that causes financial loss if damage occurs and may be transferred to an insurance market. The requirement here is mainly seen as physical damage, but after the last 6 months, we all know how devastating a risk with absolutely no physical damage can end up to be to your business. I will be focusing on insurance risk today. Next slide, please. So what is total cost of risk? In short, it is the portion of the risk that you as a business are responsible for and can consist out of a number of components as shown in the slide. For me, however, total cost of risk can be compared to an iceberg. And with an iceberg, it is that part underneath the water that you need to worry about the most. Next slide. So let's start scaling this iceberg. And we begin with the components that are visible to your business. Firstly, there are insurance transfer costs. These can be insurance premiums, brokerage costs, and any other costs relating to risk management. Next, you have your insurance retention costs. These are your deductibles, aggregate, and cost of uninsurable risks. These costs are what you expect to occur, and it's normally based on your current loss history. This now takes us to the first portion underneath the water, which is still your retained costs, but those classified as unexpected. These costs will be as a result of an event with a low probability of occurrence. Lastly, we have those costs that lies well hidden beneath the surface and can unexpectedly cause significant damage to your business. I refer to these as insurance program gaps. These are the areas of risk which you thought you got covered or you transferred, but when a claim occurred, it gets excluded by some sort of smart policy wording or a level of underinsurance. Now that you have an understanding of the four main components of total cost of risk, let's quickly go to a poll and get an understanding of which component of total cost of risk are you currently most worried about. So just ask you to poll, please. Give some more time. Okay, I'll give it a bit more time and then I'll close the polling. Okay, we can close the polling. Can we just see the results, please? Okay, Very interesting. Insurance program gaps. I think suddenly in this last impact, I mean, of the whole COVID scenario, I mean, there's a lot of pressure on this specific scenario, and we'll be talking about reducing that. Please close your poll results, and then we'll go to the next slide, please. Okay, now that we've given total cost of risk affecting your business some thought, let's look at ways to reduce this. We start with the first part of the iceberg, insurance transfer cost, and how insurers may be pricing for this risk. Firstly, there's the non-risk adjusted costs. These are the costs an insurer requires to run its own business and is driven by claims in the industry or the reinsurer capacity. This is the portion you normally hear your broker may refer to when he opens up state of the insurance market. There's not much that you can do about this other than possibly maybe combining your risk with others in industry and form a mutual captive structure. We found this to be quite successful in America, and I've seen a few South African entities adopting this approach with great success. Next, they will adjust the price of your unique risk profile based on your risk management program and your past losses. This should be your main area of focus to reduce insurance costs. Lastly, you have the CAT risk, driven again by occurrences of significant events in the market. The Beirut Harbor explosion is a recent example of a significant event that will have an effect on the marine market in the future. Next slide, please. So what can you do to reduce this specific component of total cost of risk? As everyone loves a good story, you need to tell that story to the insurance market, addressing the following factors. 1, focus on your current risk management program. What have you done to address past risk recommendations? And what are you planning to do on current risk recommendation? It all comes down to your past and planned CapEx spend. 2, what have you learned from past significant claims? And what have you changed to ensure that a claim will not happen again? Or if it happens, how will you reduce the exposure to the insurer? 3, have a view on future losses and what you will be doing to reduce the occurrence of those expected claims. And lastly, make this a non-fictional story by indicating to the insurance market you are willing to increase your insurance retention. So how do you have this view of the future? For that, I'll be handing over to Claver, who will be showing you how you can use analytics to optimize your current insurance program. Over to you, Claver.
Mornay, I see Claver has dropped off.
Okay, I'll handle that slide, that's fine. Okay, so if we look at the specific slides on the cost, you've got 3 different options to basically have an estimate of the future. 1, you can take out the all crystal ball, give it a good rub and predict what can happen. 2, you can take a good guess or have a gamble in this scenario. But I'm not a good gambler, and I'm sure you're also not great at that. So that leaves us with the third option, being forecasting. And forecasting, you make use of analytical forecasting models to determine the probability and severity of insurance risk. Now, what does that mean? I'm not an actuary, so I'm going to dumb it down to you now. I understand it. If, for instance, looking at this example, you forecast a loss of 100 Rand to occur every once in 5 years, the following basic calculation will be applied. So this is the formula. You take the loss exposure, the 100 Rand, you multiply it by the probability, the 1 in a 5, in this case, a 20%, to give you a value of 20. We refer to this value as risk. Now let's apply it to your insurance program. Next slide, please. Okay, so we start off with a basic insurance program with an aggregate of 100 million and a premium of 150 million, which is your normal starting point, to give you a total cost of risk of 150 million. Now what we want to do is we want to calculate the risk, what we call the risk in aggregate. So looking at the risk in aggregate, we now add probability, going back to the original formula, of adding probability to this 100 Rand exposure. This then brings your risk in aggregate down to 70 million. And now what's the difference is between 100 Rand and 70, that 50 million, that's what we call your probability gap. Now, what this basically says to you is that your current risk program, you expect to have losses in an amount of 70 million happening on a year-by-year basis, but there's 50 million that might only occur like in future years. Why this is important is this will give you guidance that you can now optimize your insurance program. So in this example, I keep adding my premium of the 50 million. So I'm back to my 170 million total cost, 150 million total cost of risk. Because I now have this lower probability in my risking aggregate, I can now change my program to increase the ag to, let's say, 120 million. I now apply the same formula to this 120 million. So I'm adding the probability again to this 120 million to give me a new risking aggregate of 72.5 million. I still have my original probability gap of the 50 million, but now what happens is I might have achieved a premium saving of about 5 million rand. So my premium reduces from 50 to 45. What's now remaining to top it back up to the 170 million is the 17.5 million, which we call the increased aggregate risk in excess of your saving. So at this point, the question is this program optimized, yes or no? And how we'll do this is we'll go, if you just go to the next slide, please. We need to determine if the saving is efficient to be carrying this increased excess retention that you are picking up. Remember, the plan is you want to take the saving, put it away, and then when a loss occurs, you'll be able to fund for that loss in future years. So we start off by saving, we take remember the increase was the 20 million, consisting of the 2.5 million of high probability losses and the 17.5 million of moderate to low probability losses. So we start off by taking and allocating our saving of the 5 million to that 2.5 million loss. And we say, yes, we still have a little bit of a surplus. If that probability was higher than the saving, we would have stopped there saying that your program is not optimized. So this would not be a good option to take. In this case, it is, you still have a remaining 2.5. Then what we do is we allocate that 2.5 to see how many years can we build up funding towards this. And in this scenario, you get up to about 8 years. So when we go back to our loss analytics, we're comparing that probability to that 1 in 8 year event. If the occurrence is more than a 1 in 8 year, then we know your program is going to be optimized. If it's not, then we'll stop it there. Next slide, please. Okay, so that's optimizing your insurance program. So now we go to the next step, in terms of reducing your program gaps. First off, you start off by ensuring that your risks are appropriately valued, as insurers applying the averaging clause to your claims may have a significant impact on your total cost of risk. Next, you look at the risk exposure in excess of your insurance limits. This is the retained exposure to your business, which sits between your purchase insurance limit and your maximum declared value. Lastly, and very topical these days, you need to start thinking of your ESG factors as part of your going to market strategy. Next slide. So when it comes to ensuring your risks are appropriately valued, you would want to value all your properties, but this may ever not always be cost effective. So where should you focus? I would suggest you place your focus of your valuation exercise towards your high value production assets or those assets situated in high risk areas. These high risk areas are those assets or locations with significant risk management recommendations. These locations will have an increased probability of an insurable event occurring. You may also already be paying a high insurance premium or even a punitive deductible on these assets or locations. By getting their declared values at least correct, you therefore don't run the risk of the insurer applying a general averaging clause to that specific reported claim. Next slide. Next, we look at how do you select your limit and what's the limit that you should be able to buy. So a good starting point is by looking at your highest declared value. You then compare this to your maximum foreseeable loss estimate or MFL. This estimate assumes no meaningful response from any competent emergency personnel. You would want to think that this is quite an unlikely number, but considering the current service delivery issues most of us are experiencing, it is an exposure to really consider. If you are ever lucky enough to have confidence in your municipality risk of non-delivery, you may opt to use the anticipated probable loss estimate or APL. The APL assumes that your protection equipment is in service and it operates as designed. It also allows for a normal response from both the public fire brigade and the plant emergency organizations. Now, here's where the analytics starts coming into play again. You can now complement this by adding your predicted loss scenarios from the loss forecasting to bring these two factors together. This will allow you to decide on the most appropriate limit to purchase, as well as determining, and this is what we see in the market at the moment, determining the risk of losses in excess of this limit. So you go to market and you cannot place your full risk. This is important so you can now decide if you can't place that limit, what would that quantity be? What is your exposure going to be to your board if you have a loss in this limit which you couldn't buy? Next slide, please. Now we're moving on to our last topical factor in terms of insurance gaps. Mainly relates to reducing insurer capacity caused by your ESG factors. This is your environmental, social, and governance factors. Environmental factors are those factors of your business affecting climate change and resource scarcity. In short, you are looking at the carbon footprint of your business as well as those suppliers and customers. This factor is the one currently driving the ESG disclosures. However, you need to also consider your social factors. These factors relate to your labor practices, your talent management process, product safety, and even data security. Lastly, you have your governance factors, which are those relating to your board's diversity, executive pay, and general business ethics. These factors are becoming more and more important, and underwriters are considering these in the underwriting process. What is very important to note is that these impact insurance pricing, but rather as offering capacity to good companies. Next slide. It's therefore important that you start communicating your ESG approach to the insurers. This is done by adding relevant ESG information as part of your underwriting submission, your market presentations, and even your engagement with your insurance. Highlight the diversification of your business model or your planned measures that demonstrate a commitment to transitioning to a low carbon economy. Demonstrate a commitment to reducing your own greenhouse gas emissions as well as those in your supply chain. We find that the main focus currently is on the environmental factors. However, do not ignore your social and governance factors. Highlight positives such as increased ethnic employment and your commitment to health and safety. Next slide. So let's recap. We started off with scaling down your total cost of risk, which we've shown as an iceberg, by identifying the 4 components, both visible and non-visible to you. We then introduced analytics as a way to assist you in identifying the components below the surface and optimizing your insurance program. You now use this information to navigate your business safely around these icebergs. As this is a webinar, I've tried to cover a number of aspects in reducing total cost of risk, but at a very high level. You now need to consider those factors affecting your current business, and as indicated, those insurance gaps is currently where the issues are sitting at, and then focus on ways to reduce this. The key takeaway is that you will always be faced with these risks, but use what we spoke about to determine what portion of risk you want to retain, measured against your risk tolerance, and what portion you want to transfer efficiently by optimizing your insurance programs. Thank you.
Thank you, Mornay, and especially also for stepping in there for Clayburgh, unfortunately experiencing technical difficulties. I think he owes you one. Mornay, also, I've received a question, so don't go away. Earlier on, you mentioned that the portion of risk you wanted to retain is measured against your risk tolerance. But how do you go by setting that risk tolerance?
That's a great question, Gert. And it's one becoming more and more topical for insurance retention. If I continue maybe on my iceberg theme, which I've used in the IMSA conference, we can illustrate this with the story of the Titanic, which was deemed unsinkable until that fateful night it met its iceberg. The Titanic was classified as an unsinkable because it was designed with 16 compartments. This would allow it to stay afloat with, I think, 3 to 4 compartments damaged. Key was the following. With damage to 2 compartments, it could sail uninterruptedly. If the damage now increased to 4 compartments, it will have limited operating capability, i.e. it will maybe go a little bit slower, but importantly, it will still remain afloat. Now we all know the damage was actually occurred to 6 and more compartments, and therefore the Titanic went down. So if we have to relate this to risk tolerance, you start off by determining your risk tolerance in terms of looking at your risk-bearing capacity. And your risk-bearing capacity is your financial ability to absorb losses in your operational results without affecting your strategy. This is usually determined, I think we normally use a number between 5 and 14%, me coming from an audit experience, so like the 5%, but I've seen in the industry it's gone up to about 14% impact on your financial position. This would be similar to pulling it back to the Titanic, to 2 compartments of flooding. Your ship will be damaged, but you will be able to continue as normal. Don't have to change anything. Next, you have the risk tolerance factors, which is your tolerance to pay for these unexpected losses, not out of your financial position, but out of other items like KPIs, dividend paying ability, those type of things. This level is in excess of your determined risk-bearing capacity and can be compared to the 3 to 4 compartments being flooded, which is the 2 of your RBC, as I mentioned earlier, and 2 more representing the KPI factors. This will slow your ship down, but it will still remain afloat. So now giving you the 2 lines of it, so how do you set your risk appetite? The risk appetite is arranged between your risk-bearing capacity on the lower side and the risk tolerance on the upper side. What is important to note, what we've seen in this exercise when we do similar things for clients, is that the hardening market forces the client to absorb more, retain more risk. And the risk-bearing capacity, those 2 compartments is not enough anymore. So what the clients are forced to do is really looking at a risk tolerance perspective. But be very careful. When you move into risk tolerance, that's normally what you should set aside for business risk exposures. So you need to find that perfect balance between the 2. I hope this answers the question, Khan.
Thank you very much, Mona. I think definitely a very comprehensive. Plus, I learned a bit about the Titanic also. Thanks very much for that. If we can then take 3 polls for today, please. And if we can bring up our poll question 1, please. What we'd like to do is just see if you can indicate if you would like us to contact you to discuss your current cover or expanding some of your cover. We'll be able to see who is voting yes, and then from that we will be making that selection. Okay, sorry, I think I had my polls mixed up. The question was really, have you considered your ESG factors? And what came out as 50% of respondents said that they comply mostly with South African legislation and have not considered how it may affect their insurance program. If we can then go to the second poll. All right, and here is the question I asked earlier. Please vote yes if you would like to be called to discuss your current cover or expansion of your cover. Thank you very much. And we've gotten 6 persons who is interested. Thanks very much for that. If we can go to our last poll. Here, please vote yes if you would like one of our consultants to contact you regarding the total cost of risk that we had just presented on. Okay, and let's end polling. Thank you very much. We've got 7 persons also there interested. So we will be contacting you. Okay, if you can close the poll question on your screen. I would like to thank our 2 panelists today for their insights. I hope that all of our participants on the webcast today have gained value from what we've shared. This concludes the main part of our presentation. Before we get into any other audience questions, please visit our Marsh Africa website, where we will be uploading the materials that you can use to get more guidance around our total cost of risk and other similar topics. If you have any questions, then please email us at marketingafrica@marsh.com on screen now, and we will make sure that your client executive contacts you to answer any concerns you may have, as well as share any new materials with you. We're going to move to our Q&A session now. So I will open it up again to the panel to provide any answers on that. So I've got a question for Mornay. And it says, let's say that the company does do valuations for its high-risk areas and the production area in order to get the amount that they should cover the assets in those areas for. What will happen to the areas that were not included in the insurance cover if there is an incident or an accident that happens in those areas and the dormant areas of a company?
Thanks, Gert. It's like the inverse question of the idea. It's a good question. The way I see it is that the insurer will look at what did you declare, what was the declared value, and if the insurer then comes in, the assessor goes there and he notices that actually that value has been underdeclared, he will just go and apply averaging to that location. What we generally see is that they'll take your total view. They'll start taking a total view of your assets and then use that for the formula. All we're trying to say in this total cost of risk exercise is if you don't do the whole one, at least if you focus on one specific area, you can declare that area, the insurer knows about it. So when the claim occurs in that specific area, he's not looking at your total position. But the short answer is that he will apply averaging, most likely apply averaging if it's written in your policy. I have seen some policies that exclude, that does not have the averaging clause, and will be safe on that side.
Thank you very much, Mornay, for that. Then we've got a question from one of my good friends, Leon Rousseau. Leon asks, is there a relationship between the MFL and the policy limit? In other words, if the MFL is 100 million, what is the Marsh advice on policy limit? I think GT, if we can put that up to you or the panel, between the two of you.
Yeah, policy limits are always a contentious issue to arrive at, and it's a whole question of affordability. If clients can afford to buy the limits for full protection of their businesses, of course that's the best solution and way forward. If money is an issue, then it's a question of making a calculated selection and prioritization of risk in terms of what limits to buy and where to pitch your limits. But the work that is done by Marsh Advisory really guides that conversation. So it will depend on case by case in terms of what limits to purchase. That's why we will have the strategic conversations and strategic meetings with clients to arrive at that determination. So it's just a question of affordability and prioritization of assets that comes into the equation in deciding the limits to purchase. Maybe Mona, you want to add?
Yes, GT. Yeah, you sum it up right. But what we've seen is normally, and I think it's because insurers are struggling to finding that right limit, that the client start moving really away from the MFL, down towards maybe the APL level. So I've seen scenarios where the MFL came to a certain number, because you're always collecting the worst case type of scenario, being in South Africa, I think. But then where they're saying, well, we've done enough, so we can really move it down to APL to get in. And as I mentioned, if you still not comfortable, by adding a loss analytics, so what loss analytics just add towards it is bringing in loss forecasting. So it will use loss curves, it will use loss history to try and determine if that calculates, so it's just sort of like a third option to look at to see where those limits are. But definitely in a market, what I've seen is a lot of clients are moving down to AFL, and it's really finding where you're comfortable from a risk tolerance perspective, where you're comfortable with, at what limit you can place it at.
Thank you very much. I think we've got time for one more, and you can continue to ask questions. We'll be able to get back to you offline later on. Our last question comes from Simon Baker. He asks to the panel, is a good risk management approach better than a good claims experience for clients who are trying to drive down cost of risk? I think very, very topical. And if I can put it to the panel, between the two of you, if you could just take that question.
So I'll go first on this one. Thanks, Simon. We've had sessions with most of the South African insurers where we had sit down with them and we discuss. And the message they said is really clear. Risk management program, that's key. You can come in with high deductibles. You can come in with, trying, because when you're bringing in deductibles and excesses, you're trying to say like, okay, I had claims history, but if I increase it, it's sort of like you won't have that impact again going forward. But what they've said to us is that's their focus, especially around fire protection, saying we want to see that you've done something on your risk recommendations, you are following a good risk management program, you're serious about it, and that's going to be the way for the next year or 2 years, at least till this market moves into another cycle. That's the view I've got. I don't know, GT, if you want to add to that. No,
you've covered it, Monet. The other one is really forward-looking, and the other one is sort of a hindsight based. And my example that I often use in the purchase of a business interruption insurance is that we can map out scenarios for business interruption so that by the time the incident happens, clients know exactly what is it in for them, instead of discovering what is covered when the loss has happened. So my advice is to take a proactive approach to things and make sure that we've got a full understanding and expectations are aligned in terms of what is going to happen when the loss happens. Thanks, Gert.
Okay. Thank you very much. If you have any more questions, please email them through to the marketingafrica@marsh.com. And thank you to everyone for your time today and for joining us on this webcast. Please don't hesitate to reach out to your Marsh representative if you have any concerns or questions. Goodbye.